Recently, with all of the current craziness going on, the Fed of both the United States and the UK have considered the formerly impossible negative interest rates. Today I'll go into why I think the Fed will need to go negative with interest rates, and what this means for the economy ongoing, so stay tuned. Hi everybody, welcome back to The Contrarian. My name's Logan. I really like to talk about investing and overall success, as well as going against crowd thinking, the kind of craziness that crowds tend to get into. I think a prime example of this would be the whole toilet paper craze that was driven by who knows what, but that's an example of crowd mentality that obviously gets things very wrong. So if you like these topics, please hit the subscribe and like button down below. Now, to begin with, it's important to understand how backwards of a system negative interest rates would be. This is essentially encouraging people to borrow money instead of lending it. The borrower is actually paid to take on debt, and the lender receives back less than they initially lent out. Several notable economies already have negative interest rates, and the results have not been stellar. The most notable of these is Japan. Obviously, Europe, in parts of Europe, already has negative interest rates as well. But Japan and parts of Europe who have this have all had drastic population, economic, and stock market that have not performed well for the last 30 years. Most notably Japan. They've had 3 decades of complete economic stagnation. Young people are not having kids. They're just afraid of starting families, buying houses. This is a big deal because Japan has had zero interest rate policy, or ZIRP, since 1999, and negative interest rate policies, or NIRP, since 2016. So Japan has taken this to an extreme. If we think that we're kind of crazy for thinking about this, then we should just look at Japan, because they've really taken this to an extreme. They've also taken stimulus spending to an extreme. However, this has done nothing for any of the metrics in Japan. As I said, stock market, real estate, the entire economy, population growth have either gone down or flatlined. So it's important to understand that negative interest rate policy cannot fix underlying economic problems such as trade, population, consumer spending. None of these can be fixed with negative interest rates, and in fact they oftentimes tend to exacerbate them and make them worse. The evidence shows it is ineffective at fixing these problems. So Jerome Powell has tried to avoid it to this point, and he's actually come out definitively against it up until now. However, I'll argue why it's ultimately not up to the Fed, and why they will need to go with negative interest rates, even if it is only for a short time. Now, if you saw my previous video, I think that the Fed will actually need to raise interest rates long term much higher than they are now, like 10+%. But this video basically covers before that they will need to go negative, and I'm forecasting that this will probably happen before the end of this year, likely only for a short period of time, like 6 months or less. They'll probably be in the negative territory. But right now they are at 0%, so that's not, a far draw from where they are now. Basically, many other economists have been pressing him to do it. This is referring to Jerome Powell. In fact, the biggest proponent of NIRP has been Trump, who argues that we should have it to let our companies compete on a level playing field, just like Japan has negative interest rates, parts of Europe have negative interest rates. He's saying that our companies shouldn't have to deal with paying interest that other companies don't have to pay. I don't know if this is entirely correct, but I can kind of see where he's coming at with this. But basically Trump has been putting constant pressure on Jerome Powell and the Federal Reserve in general. Trump appointed him to the Fed chair and could easily remove him. He could easily say, JP, you're fired. And he could put someone who would do it. So Jerome Powell really doesn't have a choice when it comes down to it. If Trump really demanded that he do it, Jerome Powell would probably do it. Or he would step down and, someone else would do it. But I'm basically saying that Trump commands the Federal Reserve at this point, which, probably is not ideal that one person in power commands the Federal Reserve. Now, maybe it is true that our companies deserve negative interest rate policy for competition, but this does not mean it is good for the economy, and it definitely doesn't stimulate it. Now, ultimately, it won't be up to the Fed or Trump or anybody but the market, and the current economic shutdown will ultimately control this. This is why I argue that it's pretty much certain at this point. The Fed knows that the current shutdown we're in could definitely lead to a deflationary environment, which is the last thing they want to get into. Now, I go through this a lot in my previous video, but basically deflation is like a downward spiral. It's very hard to get out of. You don't want to get into it to begin with, but when you do, you want to aggressively get out of it as quickly as possible. We had aggressive deflation during the Great Depression. That's one of the reasons why it lasted so long. It's just price decreases caused wages to decrease, and that caused, the whole economy tends to go in an upward spiral, preferably a gradual upward spiral of inflation, increasing productivity, increasing wages, increasing prices, hopefully in that way. But if you go in the reverse, it's a very bad spiral to get into. So they will do anything to avoid deflation. Basically, you have to understand, deflation is like the worst possible thing for the Fed. In order to do this, they need to either print more money or cut interest rates. Now, they are already doing as much money printing as they can for now. I know that a second round of stimulus is coming out. The current round of stimulus, most people don't actually realize this, but it's still being deployed. It hasn't all been deployed yet. So they're still pumping money from the first round of stimulus into the economy. They're going to do that again with the second round of stimulus. The Democrats want $3 trillion, the Republicans want $1 trillion. I think they'll come to a compromise around 1.5 to 2 trillion. But basically, they're going to be pumping a lot more money into the economy. But they're doing all they can right now with money pumping into the economy. Monetary injection would be the correct term for that. But in addition to that, they're going to have to go with negative interest rates. They're already at 0%. They have to cut interest rates more, which will mean going negative. I go through this in my previous video as well, but I argue that no real level of money printing can stimulate the economy to the extent that they need it to create inflation. We're already seeing deflation to some extent. It's very slight deflation, but we're already seeing deflation. The Fed does not like that, so they're going to want to cut interest rates again, which means going negative. Now let's go into what this means for the economy. First, I'll go into the positives. And this is just a recommendation, I'm not asking you to listen to this. This is not economic advice. I'm just recommending that if they were to go negative, which I obviously think is very likely, I would recommend refinancing any debt you have, because you could get a mortgage down to, say, 2.5%. That would be incredible if you could refinance your mortgage to that level, or any other debt you might have. Another beneficial long-term thing it could have for our economy would be to refinance some of our national debt onto lower or negative interest rates. I know that Trump wants to do this as well. I'm not sure if he really can do this. It might be a kind of a form of economic default on our debt, but this would be huge. It would mean that when the markets and the economy do recover, it would not be burdened down by the huge amount of debt that we have right now. For example, when inflation does finally happen, our GDP would return to much higher than it is right now, and much higher than it was before this whole shutdown. And our national debt would potentially be, equal to or less than what it is now. So that would be huge to decrease our debt to GDP ratio. As a result of this, I laid out in the previous video, I'm anticipating more stock market run-up as a result of money printing and anticipated inflation. But now we get to the bad news. Ultimately, this cannot last. The markets will inevitably crash at some point after this run-up. And when they are recovering, hyperinflation will set in as a result of this money printing and QE infinity and whatever else they've been doing. Repo markets, you fill in the blank. So, recommendations, also not economic advice, would be for people to buy gold, maybe real estate, maybe stonks during the deflationary period and crash. This would be the buying opportunity of a lifetime. Probably not going to see this again for another 90 to 100 years, the opportunity that's coming up probably in the next 1 to 2 years. So, but after this, cash will become trash, as Ray Dalio has said so many times. It won't become trash, but it will become worth a lot less than it is now. So if you like these kinds of topics, please hit the subscribe and like button, and I hope to see you again.